All right, we're just going to give it another minute here or so, let some people join, and we will get started here in about a minute. All right, I'm going to go ahead and get us started. Looks like we've got some people here. Welcome everyone to today's webinar. My name is Gunnar Fye. I am the Director of Operations here at Impact Wealth. And today we're going to be going through a webinar in a series that we kicked off at the end of December last year. Uh, I've got the pleasure of introducing Jim Teagarden, CEO and wealth advisor here with Impact Wealth. And today he's going to be covering a topic that is highly relevant given today's situation in the economic environment. So before we dive into this, I just want to say if you have questions throughout the webinar today, you can go ahead and put them down in the chat below. We will come back to them at the end of our discussion today and answer any questions that you have. And additionally, if you'd like the recording of this webinar after it's over, you can reach out to me at gunner@impactwealth.com and I'll be happy to provide that to you. You can also go to our website, impactwealth.com, where you'll soon be able to find all of our previous webinars that we've did at the beginning of this year available for you to watch. So with that said, just want to kick it over to you to get us going, Jim.
Thanks, Gunnar. Yes, welcome Friday, March 20th in Boulder, Colorado, where it's going to be like 85 degrees. Quite crazy. Yeah, relevant topic today, market volatility, wealth protection strategies for tough economic times. Um, if you haven't noticed, there's a lot going on in the world with Iran war. Our economy's changing quite dramatically over the last year or so, and will continue to be. So lots of changes, and I would say there's always lots of changes, quite frankly. And By the way, we are doing these webinars every 2 to 3 weeks. We've done a lot of pretty relevant topics. We are in the midst of rebuilding our entire website. Those videos will be on there along with a lot of other relevant topics. So appreciate the time. Glad to be here today. We are investment advisor representatives of Singe Advisory Group. So we're fiduciaries on the investment advisory side. We're a financial planning based firm. And we're also registered with Madison Avenue Securities for individual securities stuff that we do as well. We're not tax and legal advisors, obviously. So with that, I will kind of get started here. We've almost 30 years in the business. So I started in 1996, originally an engineer for a couple of years out of college, and then got into this financial planning and investment business. And almost 30 years of trying to figure out this world that we call investing and taxes and planning. And we work with retirees, business owners, executive families. I think there's so much noise out there in the investment world from CNBC, Wall Street pushing products. And I really try to help people focus on what really will work over time and understanding what's available out there. Time horizon is key. It is very difficult to beat a high quality portfolio of stocks over the long term. But when I say long term, I think it's a lot longer than people think. Peter Lynch, famous Fidelity investor, Magellan Fund, had said at one point, if you aren't willing to own and hold a stock for 10 years, you should not buy it. That is something way different than what you hear. And so for our families, we manage only individual families' wealth. We don't work for institutional money at all. There's a lot of behavioral and family issues that can cause a lot of confusion. There's a lot of things that people hear or are being sold. And I think it's very important to have a framework for your family's wealth to help guide you in tough times. So this doesn't show the tech bubble bursting in 2000, 2001, 2002, but it does show the financial crisis in '08. Shows the COVID crash in 2020. 2022, interest rates spiked 22 times in about a 12-month period. It's the highest, fastest rate of increase in interest rates in recorded history. And people wonder why things are happening. That was a big shock to the system. Current environment, pretty volatile, as I touched on. So what do you do? I like to point this out that no one really knows what's going to happen in the markets in the short term. We try to make educated decisions, but if you ask Warren Buffett, what is the market going to do next week or next month or 6 months from now, or even 2, 3, 5 years from now, he'll say, I have no idea. However, if he said, Warren, what do you think will happen over a longer term period of 15 years or so? He will be very uh, on point with his suggestions. He once put, I think it was a $10 billion 15-year put option on the S&P 500. He knew very, very closely what the market would do over the long term. Um, you hear a lot about the 60/40 portfolio. There's been a lot of press around this, especially as you get into retirement. 60/40 generally means a diversified mixture of stocks, 60% equities, and 40% bonds. This traditional asset allocation is how most investment firms work with their clients. They just provide asset allocation services, set you up with a diversified mix of assets, and that's your kind of risk reduction strategy, using fixed income as a stabilizer to the portfolio and stocks providing the upside. This asset class return chart is a little small and messy here, but every single year, this is kind of the major markets, large cap, small cap, international stocks, emerging markets, real estate, high grade bonds, high yield bonds, cash. And it shows you that from year to year, different asset classes perform differently. Some years, last year internationals were up 20%. MSCI EFA was up 20, and the S&P was only up 10. So international last year was the best. And I think what we see is a lot of clients' portfolios have a lot of hindsight bias in it. In the last year, every single new client that comes in, I wouldn't say not everyone, but almost all of them, they think they have a real diversified portfolio. And we run the risk analysis of the portfolio in a positional holding. They really have a S&P 500 type risk return profile. So uh, we tend to, as humans, say, what's worked in the past, let's keep doing it. That's not the way to, we need to be skating where the puck is going, I think, as opposed to hindsight. This is an interesting chart. So this, I think this came from Vanguard. It was or Bloomberg. I can't remember exactly. I can't read it with my old eyes. But from '76 to 2025, they did 10-year rolling periods of a 60/40 portfolio, and they came up with the average 10-year return on a 60/40 was 6.8% annualized. That's a good metric to understand. Um, in 2022, remember, if you had a 60/40 portfolio in 2022, stocks were down and bonds were down. And the typical 60/40 portfolio lost between 16 and 18% in one year. There were a lot of shocked folks who thought their bonds were their stabilizer, and they still lost way more than they thought. If you haven't done this type of report, what we do is we can take clients, all their different accounts, all their holdings, plug it in to our software, and we can come up with risk metrics on their portfolio. This just shows a 60/40 portfolio. I think it's interesting. You should understand what could happen to your portfolio in good markets and bad with whatever allocation you have. This is just meant to show you that in 2008, just 2008, 60/40 portfolio was down 18%. The S&P 500, by the way, was down 37% in that year. If you look at the October of '07 to March of '09 period, a 60/40 portfolio was off almost 30%. So over a year and a half or so, a little over that, your portfolio, if you had a 60/40, would have been down 30%. I think a lot of people got surprised at that. S&P was down 55% in that time period. So if you were all 100% US equities, you were off 55%. Um, and you can see what happened with bull markets here, different periods, pandemic, what happened, interest rate hikes, what happened. The important thing here is, as you're looking at investing, is to know how I'm allocated and what could happen in the portfolio. This should not be a surprise to you going forward, what your portfolio might do in an up market or down market. Behavioral finance issues with individual investors might be the biggest thing or biggest problem to solve, and how to prevent and avoid really bad decisions when volatility happens. And we see this a lot. We saw it in, after '07, '08, '09. People lost a ton of money in their portfolios. They automatically sold off their positions. And then the next 10 years, the next 5 years, there was huge spikes in recovery, and they missed the recoveries. So a lot of that, if you don't have a written retirement income and investment statement for your family, for you and your family, then you're really at risk when these panic moments happen. Okay. And that's what we try to help folks determine in advance, that they know what could happen. They know what they're going to do in ups and downs. So the real question for investors: how do you help protect wealth during volatility? Uh, you may give up long-term growth, but how do you really make this work for you? And there's a lot of things out there that can help with wealth protection. So we already talked about fixed income strategies for stabilization. There's also a lot of alternative structures out there, alternative assets. There's also a lot of insurance-based protection strategies, annuities and life insurance strategies that can do things for clients that is very hard to replicate on their own. Just overall diversification into real estate, private equity, other things. There's also risk management overlays, things like that. So true diversification, this is not a full list, but and by the way, we work with really three market segments. We work with retirees and pre-retirees, and typically those are 2 to 10 million in net worth type of clients. And then we work with business owners who tend to be a little younger, but have 10 to 30 million type net worths and different problems and concerns with the businesses. And then we work with high net worth clients over 50 million in net worth. And not everything you hear about is something that fits for everyone and every type of client. So, but true diversification, just talking about what's out there. Hedge funds, a lot of people, I notice out west here in Colorado, hedge funds aren't as big as they are on the East Coast, but structured notes, bank issued structured products, real estate assets, or sorry, real assets like um, metals, precious metals, energy, real assets, life insurance, annuities, real estate assets, buffered ETFs. We'll talk about those a bit. Private equity, private lending, and if you're paying attention, this private credit stuff that's going on, we can touch on a little bit, talk about that. Um, so when you get into managing downside risk, what are the tools out there, whether it's options hedging, these structured notes, tactical management, buffered ETFs, fixed index annuities, index universal life, buffered annuities, things like that. We also get into a lot of clients with highly concentrated low basis stock. So, they have maybe portfolios that are overweight to one particular security where they worked for years. So how do you offset concentrated stock position risk? We do that with prepaid sales and collars, building portfolios around those concentrated positions, charitable remainder trusts for diversification, workouts, things like that. So a lot of things out there that you can be used. One thing that we've seen here in the last couple of years is interest rates have come up. For many, many years, clients were looking for yield everywhere except for bonds because bonds weren't paying anything. The interest rate environments were really low. Today, fixed income is now something that is a little bit more part of folks' portfolios, whether that's laddered bonds, uh, structured income products, managed fixed income portfolios. And I put private credit in parentheses here. We've been preaching against private credit for the last 3 or 4 years. And when I say private credit, I'm talking about Ares and BlackRock and the Blue Owls of the world. If you've been reading the Wall Street Journal, I think those were really oversold, overpositioned. I think if you have some of those products, let us know. We can talk about what we are advising clients to do with that. But most of those are down quite substantially. They're not letting uh, you know people get out as planned, et cetera. So I do like private credit. There's many different types of private credit. It's just that I think there was a lot of overselling in that business over the last couple of years. And I'll tell you that our chief investment officer at Singe Advisory Group, for the last 2.5 years, every time someone asked him about it, he would give them his advice. And largely it was stay away from those Wall Street interval funds and products like that. So um, insurance companies can do things for individuals that they cannot do themselves, at least very efficiently. Insurance companies can lay off risk for us individually. They can provide guarantees and hedging strategies that are quite unique. And so, insurance based products, insurance and life insurance, can provide principal protection, reasonable rates of return, tax advantages, liquidity, and market linked growth. And I think, as we've talked about before, we utilize insurance based products in our business. And if firms aren't don't know how to use them, I think it's doing clients a disservice. You ought to at least be looking at what your needs are and if those can help. Um, so strategic asset class, just talking about insurance, downside protection, tax efficient growth, estate planning benefits, non-correlated returns. We use those a lot. Um, for clients that need income, not everyone, I guess there is this saying that there is no retirement without retirement income. So if you're worth 20 million, you still need to produce income. If you're worth 50 million, you still need to produce income for lifestyle. We just took a simple 65-year-old example here with a $3 million portfolio. And the key here is how do you offset sequence of return risk? And we use a drawdown strategy for high level. We say a two bucket approach. It's really more like a 4 or 5 bucket approach. But we're really saying let's use our money wisely. Let's use a bucket for the income that we need. That is either fully principal protected or partially principal protected. That still gives us reasonable rates of return. And let's use that over time to provide for our living expenses. And we're literally going to have a drawdown philosophy on that over a 15-year period. If we do that correctly, the rest of our funds can go into longer term growth assets that are have the potential for earning a lot more return over time. And if we do that correctly, we don't have to worry about short-term volatility in the market. It gives us clarity and confidence about where our income's coming from and also how we're investing to offset inflation and taxes over time with our long-term growth assets. To us, this is critical to have something like this. This gets into having a written retirement income plan. So ultimately, we've got to balance growth and protection assets. We say protection assets, income assets, and growth assets. Stability can create long-term wealth, helping investors avoid making panic decisions. And that's a lot of around the behavioral aspects of what we do. So know your income needs, evaluate your current portfolio, stay invested, avoid emotional decisions, protect long-term wealth. That's all easy to say. until the stock market and your portfolio goes down by 30 or 40% in 5 days. That can happen. It does happen. It's important to have a plan for when that happens. You know how you're going to handle it. So, who typically benefits the most? For us, high earners and executives, business owners, medical professionals, surgeons, doctors. We say, generally speaking, investors with over $1 million of portfolios. When you get into some of the more esoteric hedge funds and other things, the net worth requirement really goes up. So I think it's important to know what fits for what types of clientele. And as we talk, pre-retirees and retirees. So for us, the way we like to look at things, if a client comes to us, wants to know what's going on with their current situation, we will schedule complimentary consultation and we'll actually evaluate your current situation, your current portfolio, your current income needs, your current tax situation, how much is in tax deferred assets versus taxable assets. We'll identify your current portfolio risks, uh, provide you kind of a gap analysis. If we were looking at things, here's what you're missing maybe. And that's not all just investments. That's also tax planning, financial planning concepts, um, risk reduction, and then a fee comparison as well. What are you paying? It's important to, if you're paying for fees, you need to get something for them. So what are you getting for what you're paying? Um, so with that, we can provide income needs and drawdown analysis, and then explore protection strategies as needed. So um, I think that's what I have for today. We're about 22 minutes in here. I just want to stop and pause for a second to see if we have anything, questions rattling around, or Gunnar, if there's anything I missed, let me know. So let me know
Yeah,
if we hear anything
absolutely.
here.
It looks like we do have a few questions that came through. But before I jump to those, I just want to point out one really important thing that I think you mentioned throughout the conversation today, Jim. Uh, Knowing that you went through a lot of different strategies or potential solutions that we can provide to clients, I think the important thing to note here is that there is no one size fits all as it relates to someone's financial plan. So, if you're curious about how your financial plan is set up to support you in the future and maximizing the efficient nature of that, I would encourage you to reach out to us to schedule a conversation and allow us to take a peek under the hood, if you will, to see if we would do anything different as it relates to your financial plan. So, uh,
Yeah, that's good. I think too, you know, I say 30 years in the business, I'm a little bit of a skeptic by nature. My engineering background, my math background, there's a lot of things bandied around and a lot of things sold that if clients really understood what they had, they probably wouldn't be doing them. And I think it's hard for clients to find good resources. And I also think that the financial community in general, the investment advisors, the financial planners out there, because of how they've set up their business, or maybe they're a wirehouse, or maybe they're fee only RIA. Uh, they've restricted what they're doing because it's hard and it takes a lot of time and energy to understand everything that's out there and also to be able to access that type of all of these type of structures. So it's hard. We're trying our best as an independent firm to over 30 years now to be able to take care of clients with whatever they have, and that we can't do everything ourselves, and that's why we have Singe Advisory Group behind us. That's why we're part of Ridgeback Group. That's why we are part of, we work with NIW Corporation. We have lots of outsourced firms that provide very unique and powerful solutions that we can access for our client base. So that's a good point, though. Everybody's different, and just because you hear it on the radio or on TV doesn't mean it's a fit for you.
yeah, yep. Absolutely. So, first question we got here is how should retirees adjust their withdrawal strategy during periods of heightened volatility in the market?
Yeah, I think this is where it goes to what is your strategy? Having a plan in advance so you know you don't have to doubt. You can go, nope, we know what we're doing. We know what the withdrawal strategy is. Then you don't have to adjust or adjust much. Let's just put it that way. So I think the goal is obviously if you don't have a plan and you've got 100% in equities and you need to pull 100 grand a year off of that and the market's dropped by 30%, you probably need to wait, right? But I think for us, fitting the appropriate, your money should work for you. And there's different buckets of money for different reasons and different purposes. So it's hard to say, but I think if you have the game plan in advance, you don't have to adjust during periods of heightened volatility. That's the key here is the volatile assets. If if we're investing in assets for longer term returns or higher returning possibilities, we need time to let them work. Put those things over here in this bucket, and let's put these other things over here to provide the lifestyle needs that we need.
Yeah, yeah, that's great. Um, Another question we got here is what are the trade-offs between buffered strategies versus fully market participating portfolios?
Yeah, I think you know, a lot of folks are like, this sounds too good to be true. What is really going on here? In general, I would suggest that if you want to lay off volatility or lessen your volatility, something's got to give. You're either going to pay more for that or you're going to be more illiquid. Something has to give. And that goes back to if you look at a buffered ETF, for example, or a portfolio of buffered products or structured notes, there are costs to provide those strategies. So if I said over a 15-year period, invest in the S&P 500 or the NASDAQ only in a low-cost ETF over 15 years versus a buffered ETF portfolio using the same risk reward strategy, you will not perform as well over the long term as you would in the straight up long term equities. There's a cost to providing that. Now, however, that goes back. Actually, that's a good question here. That's a good point because if I go back to, let me go back here to this uh, lost decade approach. This is actually pretty interesting. In a really bad market period when the S&P over 10 years was negative by 9.5% over a full 10-year market cycle. So generally we say over long term, the S&P should do somewhere around 10 to 11% annualized rate of return. Well, in this 10-year period, it was a negative 10 over 10 years. That's minus 1% a year roughly. A buffered strategy, this happens to be a fixed indexed annuity strategy with a 0% guaranteed floor and a 12% cap. In that period of time, a buffered strategy, your $1 million would have grown to a million 720 versus the all S&P account that went from a million to 900. That's a $800,000 difference. So you can see the point is we don't know what the time horizon, what's going to happen in the market. So that's why people use some of these strategies. But over the long term, I would say if you looked at that same thing over 15 years instead of that 10-year period, the all equity strategy would have beat the pants off of that buffered strategy. So what am I using that for, if you will? Okay.
Yeah, yeah, that's good. And one final question that we got here is, what does your fee structure look like? So do you charge your fees for only what is under management with your firm, or how does that work?
Yeah, so our firm is set up a little differently. All new engagements, we actually charge a financial planning fee that allows us to take our clients through our Impact Wealth Roadmap, which is our process for determining what you need and what you want, and then how to deliver that. So we charge a planning fee up front. That's for the planning services. We very quickly can help clients understand what they're getting for that fee. Okay, and they decide whether they want to engage with us or not. Through that process, once we've determined the plan, we sit on the same side of the table as our clients, and we are advocating for them, whether it's a product solution or a investment advisory solution. We get paid either investment advisory fees, or we do receive commissions on certain products like life insurance and annuities. Not all, but a lot of those. And our job is to make sure that whatever the solution is, you're getting the best option. In general, there's a lot of flexibility for us to charge fees versus commissionable products. We've chosen to continue doing commissionable products, quite frankly, because they are in many respects better than what we can do by charging the clients fees. So, and then that's how we're compensated. So we have a compensation brochure that discusses that, talks about our fee structure, et cetera. What I will say is, we just did this 2 days ago on a new client, about 3 million a portfolio. They were paying about 1.35% on all their assets. By the time we were done, they're getting a much better risk-adjusted return, risk-reward portfolio that meets their income goals and their long-term growth goals. And we were able to cut their costs by about 37% annualized. That's fairly typical. Good question, though. So I would encourage you, if you're interested, to talk about fees. We do that. First and foremost, we talk about your situation, what we think we can do. Then we have the fee discussion so you understand how things work. Very transparent, though. We share with you what you're getting and what you're paying, which, by the way, most people don't know when they bring me their Morgan Stanley portfolio or whatever. And I go, "What are you paying?" They tell me one thing. I go, "Well, I just looked at it. You're actually paying a heck of a lot more than what you know." And I will tell you that transparency is a big part of our nature here. Here's what you're paying. Here's what you're getting. And if you like it, great. If you don't like it, we do something different. So
Yeah.
I think we're about out of time here. We're a little over. Any other questions, though? Maybe one last if you have them. If not, we'll close up here.
Yep, that should be good. That's
Good.
all we got.
All right, Gunnar, thanks for setting this up. Thank you all for this. I encourage you to reach out to Gunnar or give us a call at our main line here. Gunnar at impactwealth.com, 303-645-4800. And we look forward to talking to you, and have a great weekend. Go Purdue Boilermakers.